Welcome to This Explainer. Today, we're completely demystifying the mechanics of the insurance industry. Look, I get it. For most of us, paying insurance premiums just feels like a frustrating, never-ending personal expense, right? But today, we're pulling back the curtain. We're going to see how it actually operates from the inside. We're taking insurance from this boring monthly bill to what it truly is, a fascinating, massive financial engine that literally underpins our entire modern world. Let's get into it. So, let's start with the core paradox of the whole thing. Why on earth do we willingly pay for a product that we actively hope we never have to use? Well, it all boils down to a super fundamental human trait, risk aversion. Most of us are naturally risk averse. We would much rather pay a certain fixed amount right now, the premium, than face the terrifying uncertainty of some catastrophic loss down the road. Basically, we aren't just buying coverage, we're paying for certainty. Here's our roadmap. We'll be looking at the nature of risk, how we manage it, the underlying math, what happens inside the insurance machine, the wider ecosystem, and finally, the golden rules. By the end of this, you'll see exactly how humanity engineered this incredible mathematical solution to our universal fear of danger. Okay, part one, the nature of risk. We really have to begin by defining the foundational problem we're actually trying to solve here. Now, take a look at the clear dividing line between these two types of risk. On one side, we have speculative risk. Think of this as investing in the stock market or launching a startup. Sure, you might lose money, but you also have a chance to strike it rich. Then, on the other side, we have pure risk. And with pure risk, there is absolutely zero upside. Your house either burns down, which is a massive loss, or it doesn't, meaning everything just stays the same. And here's the kicker. Insurance only deals with pure risk. So the most instinctual way to handle pure risk is the internal approach, which is really just a fancy way of saying you're saving up your own money for a rainy day. But if we try to manage pure risk entirely internally, we slam right into a brick wall. Your personal savings just might not grow fast enough before disaster strikes. Or even worse, the sheer scale of the loss, like a massive medical bill or a totally destroyed home, might vastly exceed any savings you could ever reasonably scrape together. Going it alone? Yeah, it's incredibly dangerous. Since going it alone is basically a non-starter for catastrophic pure risk, let's jump to Section 2, how we manage risk, specifically looking at the external approach. Historically, we actually evolved our external approaches in two distinct ways. First, people formed non-delegated mutual funds. This is where a group self-manages their risk together. But there's a pretty big catch here. If the whole group suffers terrible losses, you might suddenly be forced to pay a surprise supplement to cover the shortfall. So you're still holding some of the back. That brings us to delegated insurance. By paying a fixed premium to a specialized third-party business, the insurer, you transfer that risk entirely. You will never be hit with a surprise bill. It's no longer your problem, it's theirs. Which brings us right into Section 3, the math of insurance. Because really, how does a delegated third-party company take on all that massive risk and, well, not go totally bankrupt? It all starts with the law of large numbers and pinpointing the exact probability of an event. Imagine there's a tiny 0.5% chance, just 0.5%, of a major loss happening to any one person. Now, on an individual level, that 0.5% feels like terrifying uncertainty. But when you zoom out to a massive scale, that terrifying uncertainty magically transforms into a highly predictable, rock-solid statistic. Let's watch this actually play out. Say 1,000 individuals face a potential €100,000 loss. Up front, or ex-ante to use the industry term, the insurer collects a relatively small €500 premium from every single person. Boom, that creates a total pool of €500,000. Now, based on our 0.5% probability, statistically, exactly 5 out of those 1,000 people will actually suffer the disaster ex post. And 5 people times €100,000 in damages equals exactly €500,000. The crucial takeaway here is that the math balances out perfectly. The many chip in a little to save the few from total ruin. All right, let's move into Section 4, inside the insurance machine. We're going to look at how these companies actually operate day to day as heavy financial intermediaries. So, insurance companies operate on something called an inverted production cycle. Think about a normal business, right? Like a baker. A baker has to buy flour, bake the bread, and put it on the shelf way before you ever hand over your cash. Insurance does the exact opposite. The company sells you the policy and collects your money up front, long before it ever has to deliver the counterperformance of actually paying out a claim. They get the revenue on day one, and the costs, well, they might not materialize for years if they ever do at all.
Because of this inverted cycle, insurers end up sitting on just massive pools of collected premiums while they wait around for claims to happen. But they definitely don't just shove this cash under a mattress. They act as massive institutional investors. They take these funds and pump them into the financial markets. This huge pool of invested capital is what we call a technical reserve. And legally speaking, this money is not their profit. It's actually considered a debt owed to the insured policyholders, kept safely invested so the cash is there the second disaster strikes.
As these operations gather millions of policyholders, we enter Section 5, the insurance ecosystem. To manage all this, they have to build out a seriously complex structure of rules, specializations, and safety nets. The absolute legal anchor of this entire ecosystem is Article 1882 of the Civil Code. This is what establishes the formal insurance contract. It's the exact mechanism that legally obligates the insurer to compensate you for damages within agreed limits in direct exchange for your premium. And because they are holding the public's money to protect us against ruin, insurance is a highly restricted, reserved activity under the law. You can't just wake up one day and decide to set up an insurance shop in your garage. Within that strict legal framework, the industry basically splits right down the middle. On one side, we have life insurance, dealing with human mortality and survival. On the other, we have non-life or general insurance, which covers property, liability, and accidents. Because the risk profiles, the payout timelines, and honestly the underlying actuarial math are so profoundly different between, say, a human lifespan and a car crash, regulations require companies to keep these operations completely walled off from each other. But here's a really fascinating question. What happens if a truly catastrophic event hits? Think a massive earthquake or a huge hurricane. Suddenly, thousands of those little 0.5% probabilities hit on the exact same afternoon. The insurer has to pay everyone at once. How on earth do they survive that without going under? The answer is reinsurance. Yes, insurance companies literally go out and buy insurance for themselves. Here's how this plays out in the real world. Imagine an insurer underwrites a €100 million skyscraper. That is a terrifying concentration of risk for one single company to hold on to. So what do? They transfer, say, 80 million of that specific risk to a massive global reinsurer. The original company keeps a slice they can actually afford to lose and passes the catastrophic bulk up the chain. It's a brilliant system that spreads risk out globally, ensuring that a localized disaster doesn't completely bankrupt the local insurance company. Finally, let's wrap things up with Section 6, the golden rules of insurance. These are the fundamentals that keep this highly complex global machine honest. These golden rules are all about keeping the system fair and preventing outright fraud. First up, there has to be a real relationship, meaning the beneficiary must actually suffer a loss if the event happens. You can't just insure your neighbor's house and cross your fingers that it burns down. Second, you absolutely must provide perfectly accurate information. And third, this is vital, you cannot profit from insurance. The whole goal is pure indemnity. It's about making you whole again, putting you exactly back where you were before the pure risk event. If someone else pays you for the damage, your insurance payout naturally shrinks. It is a shield against ruin, guys, not a lottery ticket. We've really seen today what an incredible, deeply mathematical system this is. It takes our terrifying, unpredictable personal risks and pulls them into this incredibly stable global financial safety net. And yet, despite this genius architecture designed to protect us, the source material leaves us with a pretty stark observation. A problem is that most people don't purchase enough insurance. We constantly underestimate our own exposure to pure risk. So I've got to ask, looking at the sheer scale of what we've discussed today and applying it to your own life, are you truly covered? Thanks for joining me for this explainer. I'll catch you in the next one.